The unemployment rate went down this week. That sounds like good news. It is not. 1 million people walked out of the labor force to make that number look better, and almost nobody reported it. Let me show you what's underneath. I'm Ron Siegel, Certified Liability Advisor, helping families build wealth through strategic debt management. This is your weekend update for the week of August 7th, 2026. The jobs report was weak in every single place. The July employment report came out this morning. The market expected 80,000 new jobs. We got negative 23,000. That's a miss of more than 100,000 jobs. Then it got worse. May and June were both revised down by a combined 103,000. Look at what happened to May. It was first reported at 172,000. Then it was cut to 129,000. This morning it was cut again to 63,000. That's about a third of the jobs we thought we had. June started at 57,000. It's now 20,000. Added up, between this month's number and the revisions, that's 126,000 jobs gone. Now here's the part that gets misread on television. The unemployment rate did fall from 4.2% to 4.1%. But the survey that produces that rate showed 87,000 job losses in July and about 700,000 over the last 2 months. So how does the rate go down while jobs go away? Because 264,000 people left the labor force in July. Since May, about 1 million people have stopped being counted at all. You are not unemployed if you stop looking. The rate fell for the wrong reason. The all-in unemployment rate, the one that adds those people back, was unchanged at 7.9%. That number tells you more than the 4.1% everybody quotes. One more piece, we lost 106,000 full-time jobs. The gains were in part-time work. That's not the mix you want to see. Where'd the jobs go? The damage was not spread evenly, and where it landed matters. Leisure and hospitality lost 40,000 jobs. Retail trade lost 19,000. Local government and education lost 50,000, and some of that is likely a summer timing issue with school closures. The one sector that gained was private education and health services, up 25,000. That's been carrying this report for more than a year now. Look at that pattern. The parts of the economy that respond to interest rates and consumer spending are shrinking. The part that does not is the only one growing. That's a weak report wearing a decent disguise. Wages are not the inflation problem. If you have a client worried that paychecks are driving prices higher, the data says otherwise. Average hourly earnings rose less than 0.1%. Year-over-year wage growth slowed from 3.4% to 3.2%. Weekly earnings slowed from 3.8% to 3.5%. We also got productivity numbers this week. Workers produced 1.4% more in the second quarter, more than double the estimate. Unit labor costs rose just 1.3%, which came in 0.8 below what the market expected. More output, slower wage growth. Whatever is pushing prices up right now, it's not the American worker. So where'd rates land this week? Here are the numbers your clients are actually seeing. The 30-year conventional is 6.77%. The 30-year jumbo is at 6.9%. The 30-year FHA is at 6.33%. The 30-year VA is at 6.35%. These are national averages from Mortgage News Daily, not an offer to lend. The 10-year Treasury is still trading as we record this. So I'm giving you live number, not a closing number. It's at 4.65% compared to 4.74% last week. That's a 9 basis point improvement, and the bond market liked this morning's weak jobs report. The rate outlook from here, the 10-year yield has been stuck in a range roughly between 4.2% and 4.8%. At 4.6%, we are closer to the top of that range than the bottom. The level to watch is 4.39%. That's the point where the trend flips from up to down and is less than 20 basis points away. Two forces are pulling against each other right now. The new Fed leadership has signaled it would be willing to raise rates at the September meeting if the coming inflation reports run hot. That is the risk on one side. On the other, tensions around the Strait of Hormuz have calmed, and calmer oil markets pull yields lower. So this is a tug of war, and neither side has won it yet. Hot inflation numbers keep us pinned near the top of the range. Cool ones open the door to 4.39% and below. The reports we get next week will settle more of this than anything the Fed says between now and September. So we've got some articles for you again. We put a full set of resources on the dashboard for you. Here are the ones I want to point out. Number one, from chasing a rate to reading a 30-year map of your home ownership market. Number two, everybody watches the mortgage rate. Almost nobody watches the card at 20%. Number three, the market has a clock, so does your household. Only one of them matters. And number four, your tax return says you can't afford it. Your bank statements say otherwise. There are several more on the dashboard beyond these four. All of them are on the right side of your dashboard or below the video, depending on the device you're using. When the tax return does not tell the whole story, one of those articles asks a question worth sitting with. What happens when the tax return says no and the bank account says yes? We keep a selection of loan programs for the borrower whose tax returns do not show the full picture of their ability to borrow and repay successfully. That describes more of your clients than you would guess. This week, I'm highlighting the bank statement loan. Here's how it works. We use the income your client actually deposits into the bank, not the number left at the bottom of the return after the excellent CPA or tax planner takes every legal deduction to lower their taxable income. Think about who that is. The business owner, the contractor, the commission salesperson, the person your CPA just saved a fortune in taxes, who then gets declined by a bank reading that same return. Both things can be true. Smart tax planning and strong borrowing ability can live in the same household. You just need the right program. Strategy beats rate always. The details are at rsrlinks.com/bank statement. And the debt done date. One more tool for you, and this one is free to share. It's called the Debt Done Date, and you'll find it at rsrlinks.com/DDD. rsrlinks.com/DDD. Your client enters every debt they carry: mortgage, auto loans, student loans, credit cards, unsecured debt. We then show them several different ways to strategically pay all of it off, and the date each path gets them to zero. Most people have never seen every debt they owe on one page with a finish line attached. It changes the conversation. Send it to clients this weekend and see what comes back. Next week on the economic calendar, next week is inflation week. All times are Pacific that I'm going to share with you. Tuesday brings existing home sales at 7 a.m. with forecast of 4.09 million. Wednesday is the big one, consumer inflation. The CPI report at 5:30 a.m. Headline inflation is running at 3.5% year over year, and the core is at 2.6%. Shelter makes up roughly 44% of core CPI, so another soft shelter reading would help us a great deal. We also get a 10-year Treasury auction at 10 a.m. Thursday brings wholesale inflation, the PPI report at 5:30 a.m., along with weekly jobless claims. A 30-year bond auction follows at 10 a.m. Friday brings retail sales at 5:30 a.m. and consumer sentiment at 7 a.m. If inflation comes in cooler than expected, the 10-year has room to move toward 4.39% level. If it runs hot, September gets interesting. Bottom line, everything I mentioned today, the featured articles, the loan programs, and the tools is at the right side of your dashboard or below the video, depending on the device you're using. That is the weekend update. We appreciate you listening, and we'll speak to you again next week.